Hi, welcome to this short explainer on capital budgeting. What is capital budgeting? Capital budgeting is the process in which it helps management in the decision making process where multiple projects are involved. Now, let's say a company wants to set up a chocolate milkshake factory. In the chocolate milkshake factory, it needs to have a process where the chocolate milkshake that is manufactured needs to be bottled. The company can set up the bottling process in two ways. One is automatic, in which it needs to do a heavy capex, it needs to buy a lot of machinery and all stuff. The other process is it can set up a manual process which needs huge manpower. The company will take a decision based on the technical and financial feasibility established by capital budgeting. Now that we have understood the definition of capital budgeting, let's try to understand how companies select or reject a project. Before undertaking a project, the company evaluates what all multiple projects that it can undertake. Once it decides which all projects it can undertake, it does a technical feasibility assessment where it decides whether they have the technical skill set, legal approvals and all to undertake the project. Then they do a financial feasibility where they use capital budgeting techniques to arrive at the returns that are derived from multiple projects which can be undertaken. Post completion of financial feasibility, they decide which project to be accepted and which project to be rejected. Let's assume that a real estate company holds a piece of land. It can do two things. One, it can build commercial real estate for corporates, or it can undertake a residential real estate which can be sold off for profits. Then they undertake a project technical and assessment where they try to understand whether I can get approvals, how many floors can I build. Post that, they do a financial feasibility analysis for both the projects, and based on the return that is generated by a commercial real estate project or residential real estate project, they decide which project can be undertaken further. Now that we have understood the importance of capital budgeting, let's try to understand what are the techniques in which we can do capital budgeting. We can do capital budgeting using discounted cash flow techniques where we consider the time value of money, and we can also do it using non-discounted cash flow techniques. There are two methods in which non-discounted cash flow techniques can be adopted. One is payback period, the second one is accounting rate of return. This we'll study in depth in subsequent examples. There are four methods in which discounted cash flow techniques are used. One is net present value, second one is internal rate of return, third one is discounted payback period, fourth one is profitability index. Now let's understand the concept of payback period. Say at the start of the project you invest a certain amount, say 10,000. You incur cash flows of say 3,000, cash inflows of 3,000 for every year for the next 4 years. In that case, the payback period will be 10,000 divided by 3,000, which works out to 3.33. So at the end of 3.33 years, you have recovered the entire amount. This is the concept with respect to payback period. So the definition of payback period goes as follows: time required to recover initial cash outflow in the project is called payback period. Now let's look at an example. In this example, Mr. Manoj evaluates buying a chocolate milkshake making machine, which costs 30,000 US dollars, which has a useful life of 4 years, and it generates a cash inflow of US dollars 7,000 in year 1, US dollars 10,000 in year 2, US dollars 10,000 in year 3, and US dollars 15,000 in year 4. In this case, what will be the payback period? So if you see, we have invested 30,000. 30,000 amount is not recovered till year 3. If you see, 7,000 is a cash inflow in year 1, second year 10,000, so cumulative cash inflow is 17,000. Third year is year 10,000, it becomes 27,000. So still we have to recover 3,000. 3,000 to recover 3,000, we'll be receiving 15,000 in year 4. 3,000 divided by 15,000 will give you a number of 2.4. So the payback period for this particular project is 3 years, 2.4 months. Now let's try to understand the concept of accounting rate of return. Accounting rate of return is arrived by dividing annual net income by total investment. So let's say in the same above example of chocolate milkshake factory, in the year one we are getting an income of $7,000 while we have invested $30,000. The return from that project is 7,000 divided by 30,000 into 100, which works out to 23.33%. This is the way in which accounting rate of return is measured. Now if you see the accounting rate of return definition, it says accounting rate of return measures average annual net income as a percentage of net investment. Let's understand the concept of time value of money. Time value of money means that a sum of money is worth more now than the sum of money in future. This is because money can grow through investing. If we delay investing, it is an opportunity cost. The value of money, say 10,000 hidden under a mattress, is not same after 3 years, because if you invest the same money in a government bond, it may become $10,300. Now that we have understood the concept of time value of money, let's understand how future value of money is arrived. Ideally, if we have $10,000 today, I'm saying if you invest for 3 years, it is becoming 10,300. That's how we are arriving. So there is a two components here. One is what is the value of amount that is invested. The second one is what is the rate of interest and what is the period for which you are interesting. So the formula goes like this: future value of money at the end of third year is equal to present value of money into 1 plus I is the rate of interest to the power of n. N represents the number of years for which the investment is made. This is a formula with respect to future value of money. Start with the first discounted cash flow technique, which is net present value. How is net present value of a project arrived? Net present value of a project is arrived by computing the present value of cash inflows and present value of cash outflows, then subtracting the present value of cash outflows from present value of cash inflows to arrive at the net present value. So the definition of net present value goes as follows: net present value is the difference between present value of cash inflows and the present value of cash outflows over a period of time. Once we arrive at the net present value, if net present value is positive, then we accept the proposal. If net present value is negative, then we reject the proposal. Now that we have understood the concept of net present value, let's try to do a practical sum. Now, let's use the same sum which we have used for payback period. Manoj evaluates buying a chocolate milkshake making machine for USD 30,000, which has a useful life of 4 years and is expected to generate 7,000 in year 1, 10,000 cash flow in year 2, and 10,000 cash flow in year 3, and 15,000 cash flow in year 4. In some states, we have to calculate the net present value and cost of capital is 10%. Let's see the cash outflow at the beginning of the year. We have to pay for the machine upfront. 1,000 is an outflow on day 1 and the present value of the same will be 1. Factor will be 1. So present value of outflow will be minus 30,000. And we are getting an inflow of 7,000 in year 1. Value of that 7,000 which is received at the end of year 1 as on today will be 1 divided by 1.1, which works out to 0.91, and 7,000 into 0.91 works out to 6364. Similarly, if we do the value of second year inflow of 10,000, which works out to 1 divided by 1.1 to the power of 2, which works out to 0.83. Present value of these inflows is present value factor multiplied by cash inflows. This gives the present value of inflow for year 2. The present value of cash inflow of year 3 is 10,000 and present value factor is 0.75. The value of those inflows is 7513. Value of inflows at the end of year 4 is 15,000. Present value factor is 0.68, which is nothing but 1 divided by 1.1 to the power of 4. And the value of those inflows as on current date is 10,245. If we see, we are getting a total inflow of 32,386 and we are having an outflow of 30,000. So total net present value from this project at cost of capital of 10% works out to 2386. let's understand the concept of internal rate of return. Internal rate of return is the rate of return at which net present value of the project becomes zero. Simply put it, it is the expected return from the project. Now that we have understood the definition of IRR, let's do a practical sum. We will use a sum similar to NPV, where Mr. Manoj evaluates buying a chocolate milkshake making machine for USD 30,000, which has a useful life of 4 years and is expected to generate cash flows of $7,000 in year 1, $10,000 in year 2, $10,000 in year 3, $15,000 in year 4, and we are expected to calculate IRR. If we take cost of capital of 10%, earlier we got an NPV of 2386. Now as we increase the cost of capital, NPV will come down. If I change it to 11%, it comes down to 1615. If I change it to 12%, it comes down to 873. If I change it to 13%, it comes to 156. The moment I change it to 13.223, it becomes 0. This is the rate of return at which NPV becomes 0. So the rate of return earned from this chocolate milkshake making machine is 13.223%. Now let's understand the concept of discounted payback period. Discounted payback period is similar to payback period except for the fact that we use the time value of money concept here. Discounted payback period gives the number of years it takes to break even from undertaking initial expenditure by discounting the future cash flows and recognizes the importance of time value of. Now that we have understood the concept of discounted payback period, let's try to do a practical sum. In this sum is also similar to earlier sums, where Mr. Manoj evaluates to buy a chocolate milkshake making machine for USD 30,000, which has a useful life of 4 years and is expected to generate cash flows of 7,000 in year 1, 10,000 in year 2, and 10,000 in year 3, and 15,000 in year 4. We are expected to calculate discounted payback period assuming cost of capital is 10%. If we see, we are generating 7,000 cash flow in year 1, present value factor is 0.91, and the present value of cash inflow is 6364. This all we have done up to this point is similar to NPV calculation. Now the additional step that gets involved in discounted payback period is we have to arrive at the cumulative cash inflows. For year 1, the cumulative cash inflow is 6364, whereas for year 2 is sum of 8264 plus 6364, which works out to 14628. For year 3 it is 14628 plus 7513, which works out to 22141. So now to arrive at the additional cash inflows of 7859, which is nothing but 30,000 minus 22141, we need a period of 9 months. That is arrived by dividing 7859 divided by 10,245 into 12. So it takes 3 years 9 months when the cash flows are discounted to arrive to recover the initial cost of investment. Now let's understand the concept of profitability index. Profitability index is arrived by dividing present value of future cash flows with initial investment. This gives us a number. Based on the index value, it decides how attractive the investment is. And if this index value is greater than 1, it represents that it is adding value to the company. If it is less than 1, it is destroying value to the company. Now that we have understood the concept of profitability index, let's try to do a practical sum. This sum is similar to the NPV sum, except for the fact we are calculating the profitability index. So we have already calculated the present value of cash inflows based on net present value, where we arrived at the present value of cash inflows as 32,386. The formula to arrive at profitability index is 32,386 divided by 30,000. That is nothing but present value of cash inflows divided by present value of cash outflows, which works out to 1.08.